but let's get rolling. I am recording this, so I will upload it. I don't record it and upload it to our regular Canvas site because we're only allowed to upload something crazy like a, I don't know, 320 or 640p. It's just a horrible resolution. So I'll record it in 1080 and upload it to my YouTube channel, and I'll give you guys the link to that so that you can go look at the recordings there. So if anybody's not here yet, or if you just want to review something, you'll know where to go to look for it. So without any further ado, I'm Dr. Bill Elliott, and we're here for both the undergrad and the graduate version of this class. There's going to be a slight difference between the two, depending on whether you're a grad student or an undergrad. But the basic content, the lecture, and so forth, is all similar. So we've cross-listed these classes. We do that with a number of our classes. We do that with the business finance class. We also cross-list the intermediate corporate with the financial management graduate class. So first thing, I want to just introduce myself a little bit, learn a little bit about you all, and then talk a little bit about the class. I typically end up talking, or we end up doing something throughout most of the 2 hours and 45 minutes that we have together. So plan on, being here synchronous. There is 1 week that's a week after next where I'm not going to be able to be synchronous, and I've got some alternatives for you there for those 2 class periods. But I'll still be available for any questions. So here we go in terms of first day, some introductions, introducing the course, announcements. We'll start talking about chapter 1 and 2. These are fairly basic chapters. And so first, a little bit about my background. Let me get on to a little bit about what the class is. Let's see, we're running at about 7:04 right now, so it's looking good time-wise. What we'll do, I think, just to give you a heads up, we'll take a break about an hour and 15 minutes in, and then take maybe 10 minutes, and then come back and finish up the class. So what this class is not, it's not how to get rich quick. It's not day trading 101. Sorry to disappoint you if that's what you're looking for. I definitely would attempt to dissuade you from doing day trading. Day trading is a highly risky endeavor. It makes money for the people who teach you how to quote unquote day trade. It doesn't make money for most day traders. You might be all right for a while, but eventually most day traders blow up. One of my old high school friends he had started his own company, done really well, and sold that company off, retired, and got into day trading. 2 years later, after he blew up, he was back to starting another company. Day trading, and that's a story that you hear over and over and over and over again. So please don't. Crypto, Robinhood, buying GameStop, things of that nature. Yeah, if you want to put a little bit of money into that, that's fine. But don't make that a living. That's a highly risky way to make a living. What this class actually is that we're going to learn about securities, how they come about to be, how they're traded, things of that nature. We're going to look at the stock market, the characteristics of the stock market. We're going to talk about things like market efficiency. In other words, is the price in the market, how close is that price relative to some sort of fundamental value, some sort of intrinsic value for that same security? We're going to talk about how to buy and sell securities, in particular stocks. We're going to talk a little bit about the bond market and fixed income securities, a little bit about modern portfolio theory, MPT, which is really what much of investments is based on. And then finally, we're going to talk about how to analyze publicly traded firms. In fact, the major project for the semester is going to be a security analysis, a top-down security analysis. So you're going to get into the muck and actually look at a particular firm and go through. You'll know more about that firm than 99.999% of the population once we're done with this top-down security analysis. By the way, it's going to be the same firm. You are going to work in teams. But I'll give you more details on that in a little bit. So that's where we're headed. In terms of details, it's available. The syllabus is available on Canvas. The textbook is Fundamentals of Investments. It's the 9th edition by Brad Jordan, Tom Miller, and Steve Dolvin. Brad Jordan is a really good writer, so the textbook is very readable. That was an important feature when I looked for a textbook. I know Tom Miller, he's a personal friend. Dolvin, I don't know who that is in particular, but between Brad and Tom, they've done a great job. There are a few errors here and there. I'll point them out as we run into them. Some of them are more with the homework as opposed to the text itself. But it's a really good text in general. We're using that text as an ebook. And that's on the McGraw-Hill site. So not only are we going to use the ebook, and they have this thing they call Learn Smart with the ebook. So as you're reading the book, it'll pose various questions to you about the content that you had just read. And depending upon how you answer that question, it'll suggest, hey, go back, maybe you want to review this if you didn't get the answer right, things of that nature. So again, I really like that system. We're also going to do our homework via Connect, and it will give you feedback on that. You'll have unlimited tries at it. One of the things about homework, I look at homework as part of putting in effort to learn. There's 2 steps to learning. One, you just have to put in some time. You've got to do some reading. You've got to make an attempt to understand the material, and I look at homework as part of that effort thing. So as a result, all I'm asking when you do the homework is that you make an attempt at it and you turn it in on time before the deadline. If you do that, you will get 100% on that portion of your grade. So there's no reason that everybody in the class can't have 100% on their homework. But all of that's going to be online. Wall Street Journal is a great resource. How many of you have already signed up for the student copy of the journal at John Carroll? Oh, great. Okay. Claire, Nathan, Parker. Okay, Adam. Oh, most of you have. If you haven't, I've got instructions on the Canvas site as to how to sign up for it. It's free. So make sure you do sign up for it. Last semester, GameStop was the hot thing. We spent some time talking about GameStop and a short squeeze and how that works and various other things related to GameStop. So maybe something will come up. If I see it, I'll bring it to your attention. If you see something, bring it to my attention if I haven't mentioned it. So I like to use that as a resource. We also have free copies or free subscriptions to Barron's. So if you haven't already done that, again, the instructions are on the Canvas page. Make sure you sign up for that as well. Grading, fairly simple. Homework is worth 20%. The Learn Smart assignments, and by the way, that 20%, everybody should get 100% out of that 20% of your grade, right? You should get all 200 points. Learn Smart is the ebook piece of it. So there, just by going through and reading, answering the questions, again, you ought to be able to get all the credit for that too. Just do the work on time. Do it before the deadline. The security analysis is this group project. That's also worth 200 points or 20% of the grade. And then the midterm and the final exam, those are each worth 25% of the grade. So that totals up to either 1,000 points or 100%, however you want to look at it. Pardon me. Like I said, these first 2, that's 30% of your grade at 100, right? This one, typically, I found that the teams take this assignment very seriously. There's a lot of work involved, but again, there's no reason that this 20% of the grade that you shouldn't easily be able to get at least 85 to 95% on that portion of the grade. So that's nearly a third of the grade. Or rather, excuse me, the homework's a third of the grade that you should get 100% on. Another 20 puts you at half the grade that you should be at least in the 90s, easily into the 90s on that portion of the grade. This portion of the grade is what I look at this as effort, right? You put in some effort, and I'm creating an incentive for you to put in that effort by giving you points just for doing it, just for trying. This second half of the grade is outcome, right? This is really the learning part about it, right? Learning is usually defined as some sort of endeavor where at the end of the day you end up changing your behavior. So the two exams are where I really evaluate the grade. So don't be surprised if the averages on those exams are low relative to other classes, because other classes may not have this 50% that's relatively easy to get. So at the end of the day, if you do this part, the second half should come naturally. All right, questions about the grading scheme? All right. By the way, feel free to stop and, ask questions at any point. If I'm not seeing your raised hand, I do have a pretty big screen in front of me. I've got a 32-inch screen, so I can see most of you, and I do appreciate that you're keeping your cameras on. Please, please, please keep doing that as long as you can. I understand, Brandon, I know with your connection, and occasionally that may not be possible, but please leave them on if you can. So, but if I don't see your hand up, just turn your mic on and, stop me. Feel free. So in terms of the exams, because of the fact that we're still remote, hopefully, well, at least according to what everybody is telling me, we are going to be face-to-face again in the fall, which will be great. But because of I usually have problems on here, and I don't because it's just too difficult to do it as a remote. So the exam is going to be strictly multiple choice and matching. So the matching would be terminology. I give you a definition and you pick the term that's closest to that definition. And then the multiple choice will be a combination of theoretical as well as problem solving type of things. And the security analysis. I think this is the most fun part of the class because this, if you want to think about it as experiential, I guess you could think of this as more of the experiential piece of this. I haven't picked the company yet, but we're going to pick a company. Last semester we did Sprouts Farmers Markets, which is a relatively small, not quite national chain of a grocery store that predominantly does organics and health things, that sort of stuff. But we'll pick another company similar to that. And actually, when I say we, I mean me. I'll pick the company because I want that company to be relatively easy to understand and in an industry that we all have experience with. I'm not going to pick an oil and gas company. There are all kinds of complications. There's reserves and accounting for those, and the variability in the value of the oil and the gas. It's really painful. To do a proper job of it would require a lot more knowledge than any of us have. Same thing with financials, right? Banks are unique animals. They're heavily regulated. They have capital requirements and all kinds of other strange issues that create problems for the analyst. So typically what I do is I lean towards things that are more common in our daily lives. So typically I'll do retail. Let's see, we've done restaurants. So we did Chipotle semester before last. We did Sprouts Farmers Market this past semester. We've done ice cream companies that manufacture ice cream, things like that, where the industry is relatively something that we can more easily understand, that we've experienced or can relate to. And there aren't any complicating accounting issues and things of that nature. And I also want to pick a company that isn't so big that the effect of what we're doing is meaningless, right? I'm not going to pick Apple, even though I like the company, but I'm not going to pick Apple because there are already, 4 dozen analysts who follow Apple. And besides which, Apple is also a relatively complicated company. It's not an easy company. It's not a single line company. So I'll get that company picked here in the next few days and let you know what it is. And that's the company that we're all going to analyze. And the reason that I want you all to analyze the same company, again, has to do with what we are going to do with this project. At the end of the class period, we're going to have a friendly debate. And each team is going to be here to defend its recommendation. So at the end of the day, what I'm looking for is a buy, sell, hold, strong buy, strong sell recommendation on this company. And some of you might say buy, some might say hold, others might say sell even. There might be a fair diversity of opinions about the company. So what we'll do in this debate is you'll get to defend your recommendation. And so the debate will hinge more about the details of the valuation and your future expectations and things of that nature, rather than some very surfacey discussion. Because if each of the teams did a different company, we wouldn't know your company as well as you know it. So the discussion would be at a much more generalistic level. So I want the discussion to be down in the weeds. I want it to be really down in some of the nitty-gritty things that will matter in the valuation. Let's see. You're piecing together data, and top-down means we're going to start with the economy and work our way down to the sector level, the industry, the company, and then we're going to split out and we're going to look at the clients of the company, the suppliers, customers. We're going to look at the employees, everything related to this company, everything that makes this company tick as much as possible, given that now in this summer class, we only have 7 weeks. So this is going to be a lot to do in 7 weeks. But I've got more details on that. And like I said, once I have the company selected, I'll put the assignment up on Canvas. And I think the assignment itself is 3 or 4 pages long. And then I've also got some other additional supplements to help you as you engage in this project. We're going to have basically 3 different deliverables throughout the semester. So the first deliverable will be about mid-semester. Second deliverable will be about 3/4 of the way through. And then the final deliverable is the final project, and that will be at the end of the semester. Questions about anything so far? All right. Another thing, and again, this is difficult to do in a 7-week session, I've actually scaled back my expectations on this, but as part of the Bloomberg terminal, and by the way, I don't know if you've seen the new data analytics lab downstairs in Bowler. It's a really nice setup. So they've put together this 5-panel vertical screen up at the front of the room. And at the back of the room, we have a station for the Bloomberg terminal. Unfortunately, we still only have 1 terminal, but nevertheless, it's not too hard to share it. We still have remote access to the terminal as well. So for those of you that haven't used the Bloomberg terminal is just a vast array of data, just huge amount of data that Bloomberg sucks into the system, and they value add to that data. It's not just, oh, here's a bunch of data. No, they've got Bloomberg Intelligence, the BI piece of it. Some of the databases are unique to Bloomberg, and especially relating one database to the other is unique to Bloomberg. Bloomberg is just ubiquitous, really, in the financial sector. So this is the full-blown terminal. There are a few add-ons that you can get that we don't have access to, but for the most part, we have the entire meal deal, if you will, that you would have if you were an analyst on Wall Street. As part of that terminal, Bloomberg has put together this thing that they call Bloomberg Market Concepts, or BMC. Now the BMC, and let me just see if, make sure my, is my terminal still logged in? Oh yes, beautiful. Sometimes it'll kick me back out. So the BMC is a self-paced e-learning course, and it's usually a bunch of relatively short videos interspersed with talking heads, interspersed with questions, quizzes as they go. What we're going to do, the first set of the modules that they have is the core concepts. So you're going to do the economic indicators, and you're going to do equities, and then you're also going to do, so that would be these two, and then you're also going to do getting started on the terminal. Actually, I would say do this one first, because it'll help you to navigate through the terminal. And then you can pick up these two. Ideally, if we have time, if it doesn't get crazy, we'll have a second due date on this, and it will be for the currencies as well as portfolio management. So that'll be 5 separate sections in the BMC. And let's see, let me get over here to the terminal again. Okay, so how many of you have access to campus? How many of you are close enough? Now, I know, Adrian, you're probably not going to want to make the trip up, but let's see. I see Matthew, Abby, Claire, Marcus, Nathan, Ben, Corey, Alex, Brent, Adam. Do you have access to campus? No? Okay. Well, so here's why I'm asking. The first thing you'll want to do is to get a Bloomberg login. And does anybody already have that? Alex, you do? Okay, great. You're halfway there then. So if you haven't got a Bloomberg login, the easiest way to do it is to go to campus and go to that first floor data analytics lab and get on the terminal and create a login using your John Carroll email address. That's pretty simple to do. And there's support if that doesn't work. You can call Bloomberg directly at their 212 number that's on the terminal once you get in there. And they're really good about the support. But for the most part, you shouldn't have any problems creating an account on the Bloomberg terminal. That's step one. Now, if you're remote, we do have remote access. In fact, that's what I have going right here. This is a remote terminal. And I've got this running on my iPad, actually, which took a little doing. But that's the problem with the remote, is that you've got to install this thing they call the Citrix receiver. And you've got to then make it play with your browser. And sometimes you just have to, cross your fingers and flip a coin and hope that it comes up heads or something. Occasionally, I've had difficulty getting in here. The other problem we have with remote is that if somebody's at the physical terminal and they log in, they boot you out. So I could get thrown off at any point if somebody happened to walk into the data analytics lab and logged into the terminal. Usually they get notified, hey, somebody else is on there. Most of the time, I think the inclination is just to hit the enter key and go, okay, kick them out. So I could get booted off right now if somebody walked into the physical terminal. But if you don't have any choice, it's possible. Work with it. There's some information I can show you. I've got a video that I'll give you the link to that will help you if you're remote. So once you get in there and are logged in, then step 2, you still have to create another login so you can do the Bloomberg Market Concepts. Now, the good news about that is that once you've created that second login for the BMC, then you don't have to go back to the terminal to do these modules. You can actually do them on a regular web browser through their website. So that's the good part of this. So to get your BMC login, the terminal is not the most intuitive thing, but this is Bloomberg. we don't get to tell Bloomberg what to do. They tell us. So the key operating thing here is this little blue box. Sometimes it's just a little blue rectangle up in the upper left. It's just below that. I can't point to it because I don't have a marker in this. But you see the little red rectangle up there with cancel? Can't see? It's just below there, and it's that flashing blue. So here what I'm going to do is I'm just going to type in BMC. Oops, just one. And as soon as I start typing, it immediately starts coming up with varieties of choices here. This first one is the one that I actually want, the function BMC. So I'm going to hit return to select that. So here is the beginning point to the Bloomberg market concepts. And what you're going to want to do, you could go through this overview if you wanted to. Here are the course modules. By the way, there are many more modules than what we're going to do as part of the class. I'd really strongly recommend that you do these. I enjoyed it. I thought it was a useful time that I spent doing this. I think in total they've got about 12 hours of content here. But you're going to want to go to this number 6, sign up. And you are going to continue as a learner. You're going to put in your information. I want this keyboard a little bigger. Come on. No, it's not going to cooperate. All right, I'm just going to type in Bill. Oops, sorry. There we go. Come on. Behave. And then here you're going to put in your JCU email address. And then just make up a password. Oops. Now, when I hit sign up, it's going to tell me I've got an error because I already have an account. But in your case, you'll just get an email. Oops, no, it's giving me an error because it didn't like my password. Not enough characters. One letter and one number. Okay, 1. There we go. Let's try it again. So you'll see, or maybe not. Sign up.
You have to probably hit the checkbox that says you read the terms.
Oh, there we go. Yeah. Thank you. I knew that was there. And then there's one other checkbox here that I'm looking for that I'm not finding, and it's to enter the class code.
I didn't see that either when I signed up for my account.
Oh, didn't you?
Oh, and I couldn't get onto the terminal to do the courses after I had left campus for some reason. Probably because of that.
It could be. Yeah, now normally there is another little checkbox that says I'm taking this as part of the class. And don't know why I'm not seeing that. Continue as a learner. I'm going to have to look at that again. As I said, Bloomberg is not the most intuitive thing. They don't have to be. They're the only game in town. Actually, I've got a video again on this as well. Now, let's assume for the moment that you've gone in here, you've created this login to the BMC. Then you can go to another tab here and type in here we go, portal.bloombergforeducation.com. And I'm going to log into that. All right, don't want to change that. And you'll be able to actually take the BMC right here. So once you've created that login for the Bloomberg terminal, and then you've created a login for the BMC, then you don't have to use the terminal anymore. So that takes away a lot of the problems because it's the terminal that is the difficulty. Once you're in here, then you're just going to click on each of these sections and it'll start the program for you. And yeah, there we go. So there's usually video that starts things off. And where is it? There we go.
The stock market is a primary source of financing
so that
for
makes it a
large
little
and
bit
medium-sized
easier,
corporations.
Given that you don't have to be on the terminal to do this. One other, and I apologize for this again, as I say, Bloomberg is not the simplest thing in the world. If you are doing this as a remote login, there's a step that you'll have to take before you try to access Bloomberg remotely, and that is located right here. So terminals, you'll have to go to this terminals tab, and basically you just request permission to access Bloomberg remotely. That'll show up on my screen here, and I will grant you permission. So basically this is just to prevent somebody who doesn't have a reason to get into Bloomberg remotely or isn't associated with John Carroll from getting into our Bloomberg terminal. So that's one extra step that those of you that have to sign up for Bloomberg remotely, you'll have to go here first. And note, this web address is portal.bloombergforeducation, all one word, .com. And then you'll go to the terminal tab and you'll request permission. I'll look at this every day for the next week or so. And as soon as I see it, I'll grant you permission. Then I think it generates an email to tell you that you now have permission to go in to the Bloomberg terminal itself. And by the way, the Bloomberg terminal itself is over here. It is bba.bloomberg.net. So that's for the remote terminal. And then once you're logged in, you'll just put in your login information. There's also a confirmation either by text or email to actually get logged in. But give that a try over this next week, especially if you're nearby. Just go to campus. It's so much simpler. Get your login created for Bloomberg. Create the BMC account as well. And by the way, I should also note, there is a possibility that you get into a spot on the portal.bloombergforeducation.com that says, hey, you can get this for $149. Do not, under any conditions, pay for this. We are supposed to get it for free. And they use that portal website for both the paid version as well as the free version that if you're a subscriber to their terminal that you already get. So do not pay $149, please. Okay, questions?
I have a question.
Yeah, go ahead.
I sent in my request for the terminal on the 16th of...
Oh, okay.
I don't know if you ever saw it. Or...
I did not. I wasn't expecting to see it, but let's see. Let me see if I've got you in here. On the 16th of June?
June, yeah.
Oh, here you are. Ah, come on. Behave. You are all set.
Cool, thank you.
Mm-hmm. Yeah.
Is this terminal?
It's in the Bowler College on the first floor. So when you walk in the front door, go past the dean's office and hang a left, and you'll see it right there. We've got the ticker running around the outside of it, and glass doors. You'll see and it's at the back of that room. It's what used to be Classroom 106, if you happen to be familiar with that. No, but you'll find it. It's easy once you're down by the dean's office. Any other questions? All right. Let's see. Let me just make sure I don't have, do I have anything else here? I think that was it on this slide deck. We're at about 7:37. Why don't we take about a 10-minute break? So before we actually jump into the material for the class, let me just briefly show you around Canvas here. I don't know how many other faculty are using it in the same way, but hopefully more than less. Just kind of a start here on the front page, basic information. And the nice thing about this setup is that, hang on a second. Oops. And I need to go over here, get out of the way. You see this next button down here on the lower right. And so once you've finished a particular page, and you may have to scroll down a ways, you just hit next and it goes on to the next subject matter. Scroll to the bottom, hit next, and it goes into the next area and so on. So I've structured the entire Canvas course to be like that. So for instance, when you get started on the material, so here is the first set of items that you'll have to work on. By the way, I should also say that normally the due date for your exercises will be at midnight the day before we meet. So midnight on Mondays and midnight on Wednesday are the due dates. So keep that in mind. Now, this week is going to be an exception because we're just getting started. So what I've done is I've taken both the material for today and for Thursday, and that due date is July 10th. So that's, I believe, this Saturday, right? So you'll have a couple of chapters to read here, chapters 1 and 2. And then the next due date, yeah, I've got that as July 10th as well. I thought that was the 12th. Let me just double check. I'll double check day 2. Actually, that is, I guess day 2. Yeah, day 2 is Thursday. So that's also July 10th. So again, just more reading. And then we'll start in the Monday, Wednesday routine. So just get into the habit. Once we've gotten through this week, it'll be Monday and Wednesdays are the due dates. And as far as what you have to do, it's all laid out here in the overview. And again, excuse me, I don't have this set up on a button, but you get out of the way so you can see that. So in this case, you're just having to read the first two chapters out of Jordan Miller and Dolvin. If you haven't registered for Connect yet, and I see that a number of you already have, but if you haven't, you can just click on this Connect button here. It'll take you over to a video to show you how to go through that process and so on. If you have already done it and signed in, then this will take you to the reading assignment, and it'll automatically take you over to McGraw-Hill's Connect, and you can get started on the activity. So in this case, I'm going to launch the SmartBook 2.0, and I'm going to start with reading. And then you can go, once you've done some of the reading, you can go back to the questions and answer the questions, and that'll help help you to confirm that you feel like you've got the material, or maybe you need to go back and review it. And so that's going to be the case with all of these items. Oops, I didn't really want to block that. Then go back to the modules. And so I've got an overview, and then I've broken it out step by step. So you could access it here as well and go on to next. Also, I'm going to ask that you at least post a discussion item. I'm not going to be a real stickler about posting every time, but I would like you to post, when possible. I'll try to also respond. And if rather than posting a question, if you want to answer somebody else's question, that's also good. But I've got a discussion forum set up for each set of chapters, and then the attend class, and then you go on to the next item. This actually, I'll post these. You don't actually have access to this yet, but I'll also post the slide decks that I'm going to be lecturing from. And then when you're done with day 1, that's it. And then go on to day 2. And again, same drill. Here's the overview. So you need to read chapter 3, make a post, and then attend class on Thursday. And it isn't until day 3 when we start hitting some homework. So on day 3, you're actually going to have, reading out of chapter 6, and then homework from chapter 1 and 2. And again, just clicking on that, you can click in here. It'll take you to the McGraw-Hill and so forth. So hopefully that makes your lives a little simpler. Once you've completed that module for day 1, 2, or 3, then you've done all of the work and you've got it in before the deadline. Just keep an eye on those deadlines, though. Questions about any of that? All right, very good. Excellent. So let me go back and grab my PowerPoints. Okay, where did I put that? There we go. Okay. So I'm not going to go over all of this in great detail, especially chapter 1. It's fairly rudimentary. A lot of these things you're probably already familiar with, but I do want to make sure that we have some sort of common base from which to work. They lead off the chapter by talking about how to retire with $1 million. For most of you, 1 million won't cut it, right? I mean, with inflation, it's going to require several million. But if you wanted to just get $1 million, I mean, there are a variety of ways. I mean, you could start by investing $300 per month at 9%. That would take you a little over 36 years to get to $1 million. If you wanted to make the investment of $500 instead and take a riskier position in the market at 12% per annum, then 25 and a half years. So you get the idea. This is all quite possible. One of the, let me see if I can find this slide or this Excel spreadsheet quickly. If I can't, I'll come back to it next class. Yeah, here it is. I hope this will work here on my iPad. All right. And let's see. Anybody know how to recalculate on an iPad? I know it's F9 on a keyboard, but I'll show this to you on Thursday once I figure out how to do the recalculate on an iPad. Basically, this is a little simulation that shows you over a span of time. And in this case, I believe we're talking about 35 years. If you were to put in X number of dollars per period per month, what would you end up with? And the neat thing about this is that it simulates the real world. It says, well, suppose that the market this year had a 25% return, but the following year you lost 10%. And the following year after that, it was only 3%, and so on. Well, and so you can see right here on this graph, these are the returns to the market in this particular iteration. And one of the things that I don't think enough of us really think about is that while on average the market has done really well each of us only get one path through it. We only get one pathway through 35 years. And that pathway varies considerably. And that's what this actual little spreadsheet will demonstrate to you. You could end up with $500,000 or $1.5 million, depending upon the luck of the draw in terms of the return on the market over that 35-year span. So there is quite a bit of variability in this. And as I say, I apologize. I don't know how to recalculate on an iPad in Excel. Like I say, it's F9, but let's see, is it up here anywhere? No, we'll just do that. We'll do this on Thursday. I'll come back to it. But this is also about thinking about, what do I need to put away to retire? And so really the answer is probably a lot more than you ever wanted to put away. All right, back to the slides. Oh, and by the way, I have these links are live, so feel free to click on these. This is a little link about how to retire as a millionaire, which, as I say, all of us need to be focused on. Just a couple of terminology things here to deal with. Dollar returns. What's a dollar return? I think most of you probably already know that, right? On a stock, it's the capital gain or loss plus the dividend. If the stock happens to be a dividend, it's those two things together, as opposed to the percent return. And the percent return as a percent of what we have initially invested in it. Now, the dollar return matters to us in terms of, are we going to have enough to retire on? Percent return matters if we're comparing one investment to another investment. And here again, we're just taking the total dollar return and scaling it by the beginning investment, or in this case, just simply the beginning stock price. Annualizing returns gets a little trickier here. So in this case, we have Cisco Systems, and we start off with it at $30 per share. 3 months later, we sell it for $31.50, and we receive no dividends. So all of our gain is in the form of capital gains. So it's $1.50 gain on $30, right? So that gives us 0.05 in decimal terms, or 5% return. But that's only over a 3-month period, okay? What's the annualized version of that? Well, one could say, well, gee, it's 3 months. There are 4 3-month quarters in a year. So 4 times 5 is 20%, right? That's one way of doing it. That's accumulating the returns. But actually, a better way of doing it is, since we have now received back that $31.50, what are we going to do with it next quarter? And we're not just going to take the 30. We're going to take the entire $31.50. So we're going to take principal plus interest, and we're going to reinvest that next quarter. And if we're able to do as well as we did this last quarter, then we'll get 5% on not $30, but $31.50. So this is called compounding, obviously. And the term that we use here in terms of the annual return is we're looking at the effective annual return, not a cumulative return. And to get the effective annual return, we want to use a formula like this. So here we're taking the principal. You can think of that 1 as that original principal, plus the return that we got in 1 quarter or 3 months. And then we're raising it to the 4th power because we have 4 quarters in a year. And when we do that, instead of getting 20%, we get 21.55%, because we're getting interest on the interest in the subsequent 3 quarters. And that keeps building up. And of course, compounding is why it's so important that you start saving now, not when you're my age. I don't get much benefit out of compounding. You all will. Absolutely. Now, this doesn't look like much. It's only 1.5% more, but when you put it over a 30-year window, it really makes a difference. Remember, this is a compounding effect. This is exponential. So the longer the window, the more valuable this thing is. So that's one way of annualizing it. The other way is, suppose that we actually hold the investment for longer than a year. We still want to talk about it in terms of annualized returns. How do we do that? And here's an example of how we do that. So we're talking about J&J here. We bought it at 60. We sold it at 64.50. Again, no dividends, but this is now 3 years later. So we have, over that 3-year span, we have a 7.5% return. How do I get this effective annual return on that basis? Again, the simplistic thing to do would be to say, well, 7.5 divided by 3 is 2.5% per year. But that'd be wrong, right? Because and this is the odd part about it, is that if we're not told about compounding, we always end up compounding annually. So here, to get the effective annual return, we're going to find that the return on an annual basis is less than 2.5%, not more. So the formula actually looks like this. So we're going to still take that 1, that's our principal, plus our return over the period, 0.075 or 7.5%. But instead of raising it to the second power if it's every 6 months, or the fourth power if it's every quarter, or the 12th power if it's every month, we're going to raise it to the 1/3 power, or in other words, take the third root, right? Because a fractional exponent is a root. So square root would be 1/2, a cubed root would be 1/3. So this is 3 years. So we're going to take the cubed root of that, and it's going to turn out that 2.44% is the effective annual yield that would give us 7.5% over a 3-year window. Okay. Then the chapter kind of jumps into looking at long-run returns. How have small stocks done relative to large stocks, relative to treasuries, relative to inflation? Now, before we jump into this data itself, I want to point out something. As I minored in econometrics when I did my PhD in finance. And as an econometrician, that is sort of like a statistician who deals with predominantly problems that we experience in financial economic markets. And there are a lot of them. But so I know a fair amount about statistics. And in particular, I know a lot about econometrics. I also know how to lie with data. And what I want to point out to you is that everything you look at, always look at the scales that people are using. Because in some cases, it's purely just innocent. And in this case, I would argue that it's totally innocent. But look at this scale over on the left side. It goes 10, 100, 1,000, 10,000, 100,000, million. So it's a logarithmic scale. Each increment is, the next increment is 10 times the prior increment. So that's why when you see small company stocks and you see that $1 invested back in 26 ends up being almost 30,000 in 2016, and yet large company stocks are 64.60. If you just looked at the graph, you would think, oh, gee, they're about the same. They're not all that different. Well, actually, they're quite a bit different, right? You know, the large company stocks are 1/5 approximately of the small company stocks. But it's because of this logarithmic scale that they look like they're pretty close together. The same thing with the treasuries and inflation. Now, if I were to do this on a regular numerical scale, the problem is, and what they're trying to get away from, is that these 3 lines down here, they would be flat lines across the bottom. We couldn't tell what they were doing because they would be so small. And then we'd have another line that goes up about like that for large stocks, and then we'd have a line that goes up like this for small stocks, and that's all. So this is a fairly innocent problem, but it's one that you should always be aware of. The other thing I want to raise about this, and this is where it gets a little dicier, And one could argue that this is a bit misleading. Small company stocks. How many of the small company stocks that we bought back in 1926 do you think are still in that portfolio today in 2021? Not many. In fact, I don't think, you're either going to go under or you're going to become a large company stock. So probably none is the answer. So during this entire period of time, I'm doing an extensive amount of buying and selling. And while today we can go to Robinhood or we can go to E-Trade or we can go to TD Ameritrade and we can buy and sell for a commission of exactly $0, back then, no, we're talking serious money to buy and sell. Just the commission. I'm not talking about spreads, just talking about commissions. We're talking about triple-digit dollars for a single stock trade of any size. They started at $7,500 for a commission. And that held well into the latter part of this century, well into this realm right here, into the 80s and 90s. Commissions were still quite high. It didn't really become deep discount brokerage until we had the internet. And then we found that we could drop the price even further. Now, we'll talk more about brokerage prices and how they subsidize that and that sort of thing in the chapter on the stock market. But that's not the point here. The point here is that if I were to actually make these trades and pay the transaction costs, which they're not accounting for in this, there's no way I'm going to have $29,000. I'm going to be spending a heck of a lot of my money on commissions. So this graph is really misleading in the sense that it doesn't account for transaction costs. So you always have to ask that question. Does this account for everything? And the answer in this graph is no, it doesn't. In fact, we don't even know how to account for it, right? Because we don't know whether my commission is the same as your commission. So each person's commission that they pay is going to end up being different. If I were a broker, I would pay a lot lower commission, but I still pay something. So be really careful when you look at data. Be skeptical of every piece of data that you see, even in a textbook, even in an innocent situation like this. They're really trying to show you how much return you can get by investing in equities. And there's no question that that's true. But there are a lot of caveats that you have to take account of. Then they break it out a little bit differently here. They say, well, let's look at different asset classes. So let's look at stocks altogether. Let's look at bonds. Let's look at T-bills, gold. So we're going to throw in gold now, CPI. And actually, we're going to go all the way back to the early 1800s. And again, we're going to start off with that dollar in each of these categories. And if you held that for this, we're a little over 200-year, or about a 200-year span, that dollar turns into allegedly $28 million. And again, that's not net of transaction costs. And believe me, even though transaction costs are small and you might go, it's not going to make that much difference. Trust me, it really does, especially when we compound it. All right. So, but again, the point of this graph, there are a lot of returns to be had out there. If we look at this on an annual basis, we see a little more of the variability and the volatility in these things. So these are the large company stocks. And here again, we're just going back to 26. And again, scale matters. Notice the scale because the next couple of graphs, we're going to change that scale. So here, stocks generally did well. One of the features that we also see is that when stocks did poorly, here, that was usually followed by some of the better years up here and here and here. So it's not unusual for a really bad year to be followed by a really good year. Now we're in small company stocks. And again, notice back here we were 20 increments. Now we're at 50 increments, so a lot more volatile. And there were some years where right after the crash, we had phenomenal returns immediately following the crash. And likewise, we had a few bad years here. And again, we had some really good years following that. So there's this other concept that you can think of it as anytime we perturb the marketplace, we have a bad event. That creates volatility, and volatility begets more volatility. So the one thing you can definitely count on is that if there's a shock to the system, that shock is going to create volatility for, depending on the shock and how systemic it is, for weeks, months, or even years into the future. But it's going to settle down over time. And eventually then we go back to a steady state. Here we go into long-term bonds. And again, notice the scale. We drop down to 10 units per increment. Bonds clearly are less volatile. The one period in particular right there was the period of time that we probably won't experience again. That was the DIDMCA, Depository Institutions Deregulation and Monetary Control Act, for anybody not up on their history of the 80s. Basically, what that did was that deregulated the interest rate market. And that was, talk about a perturbation into the system. Man, that threw the system way out of whack. So for a number of years, we actually experienced double-digit mortgage rates, right? I mean, mortgage rates were in the high teens for a relatively good client too. We're not talking about somebody who's got a bad credit score. We're talking about the average mortgage rate was in the high teens. And again, I'll also tell you, I try to separate out fact from opinion or from an educated guess. I guess I would put this more in the educated guess category. My educated guess is that DIDMCA had a lot to do with why interest rates went nuts in the early part of the 80s. Markets just had to adjust. Prior to the DIDMCA Act, the interest rates were capped. So if you had a savings account, you were going to get 5% at bank A, B, C, and D. The only way the banks could differentiate themselves was they were allowed to give you things. So if you opened up an account with bank A, you got a toaster oven. But we could only pay you 5% on your money. After DIDMCA, the caps came off. So all of a sudden they were in competition for accounts. And one bank would offer 0.5% more. Money would follow that higher rate. And so it led to this crazy interest rate period. So back to the point, generally speaking, interest rates have been below the 20%. And typically no periods where they've been really bad, with the exception of the financial crisis. Had some pretty bad situations there. Now we look at T-bills, and T-bills, again, notice the change in increments, 2 percentage points. And again, this part right here, you can pretty much throw that away. That's that DIDMCA nonsense. So typically, interest rates have stayed at or below 8%. And luckily, I don't know how to think of negative interest rates in Europe. They played around with that. We luckily didn't go there. As an economist, there is no such thing as a negative interest rate. So from a theoretical point of view, I don't even know how to think about that. But we have had rates very close to zero. I mean, just look at your savings account rates. I opened up a checking account the other day at Chase, and the rate was it was like 0.00 something or another. It's like, why even bother? I mean, let's just call it zero. But here's another interesting feature. Why don't we see any negatives here? There's nothing, even during the financial crisis, there's no negative here. The hint is right up here. Anybody know about the maturity period for a T-bill? No? Less than a year. So there's no way, I mean, the negatives that I see back here on the bonds are not because they've defaulted. These are, these are U.S. Treasury, or these are Treasury bonds. It's not default. It's because the value of the bond dropped. All right? But here, since the period of measure is longer than the maturity time on the Treasury bill, then I never have that. I always get back my money. And by the way, also Treasuries are discount instruments too. So, I buy them at a discount and they return the face value to me. So that's why we don't see any negatives here. Inflation, again, notice the scale here. And again, it's been well under control. Of course, there has been a lot of talk recently about inflation rearing its head. And I don't think anybody from the board of governors at the Fed to anybody on the street can really tell you. Certainly there's a risk of inflation. We have been spending money like the proverbial drunken sailor as a society, but for good reason. I don't think austerity worked in the financial crisis. I think this has been a better way to do it, and I think most economists would agree. Again, we're verging into that realm of opinion. I apologize. But nevertheless, inflation has been well under control for decades and decades, which is pretty phenomenal. And again, this impacts you and I trying to earn that $1 million to retire on, right? Inflation, just a little bit extra inflation compounded over 20 or 30 years is going to make a big difference in the price that you pay for things. Another couple of things to think about here. Average returns. How do I get an average return? How do I get a standard deviation of that average? How do I look at that average? Is it arithmetic or is it geometric? So that's what the rest of the chapter talks about here. So a typical average, I apologize. I usually go through in advance and fill in this. I've yet to figure out why my iPad does not represent certain symbols well, but it doesn't. So let me fill that in now. Just a regular old average is simply the sum of the yearly returns from 1 to n, however many years we have. So if n is 10, we've got 1 to 10 years. And then, of course, we just divide it by 10. And by the way, I should mention that this capital sigma, that has a very specific mathematical meaning, right? So when I say sigma from I equals 1 to n of yearly returns, they should actually put a subscript I there. I don't know if they missed that in the text or not. I'll have to go back and look. So what that means is that I'm going to increment from 1 to n, and this summation actually means that I have, I'm just going to abbreviate R1 plus R2 plus R3 ... plus R10. So basically what that sigma I equals 1, and if this n is 10, what that means is I have 10 elements in a sum. So it's just a shorthand way of saying that, right? And then I'm going to divide this whole works by 10. So that's a historical average return. Pretty easy, pretty basic stuff. If we do that for these various categories of assets, such as the large company stocks, small company, long-term corporates, long-term government, and treasuries, this is the type of return we get. So nearly 12% on large company stocks, a little over 16% on small company stocks, and then 6.3, 5.9, and 3.4 respectively on corporate, government, and T-bills. Now, the other thing that we'll often do is we'll state these in terms of a risk premium. And we think of the risk-free as a treasury bill. All right. And remember, we're in an unusual period of time where treasury rates are zero. So don't think of them as necessarily zero over time. This is a very unusual period of time. So we've got this idea of risk premium. Basically, all we're doing here is we're taking the 11.9 minus the risk-free rate. So I'm going to represent that as R sub F, which I use the T-bill as a proxy for. So I end up with 8.5% as a risk premium. And here I'm taking 16.2 minus 3.4, and I end up with a 12.8% risk premium. So that's the premium that I get for taking on risk. The T-bill is going to guarantee me my money back plus whatever interest I've agreed to a priori. But if I'm buying anything other than the T-bill, any of these four elements, I'm taking on some level of risk, and I should get some sort of recognition and reward for taking on that risk. The other thing that a synonym to risk premium is called excess return. Think of it as in excess of the risk-free. Not to be confused, mind you, we're going to be talking about abnormal returns, and we're going to be talking about expected returns. These are different than excess returns. An excess return is simply the risk premium, which is simply the amount that we get above and beyond a risk-free return for taking on risk. An abnormal return actually is a return that we're getting more than we should get. These are rare animals. These are the things that we search for. These are what if you've ever heard of somebody saying, I'm in search of alpha, looking for alpha, alpha is an abnormal return. And again, we'll get to alpha later on in the class. I think that comes in chapter 11 or 12. Okay. Expected returns also are in that same realm. An expected return is what we think we should get given the level of risk that we take on. Both of these are related to a thing called the CAPM, which is shorthand for the capital asset pricing model. Excess returns are simply the risk premium or the amount above and beyond the risk-free rate. And so, first lesson, there is a reward on average for bearing risk. Big surprise, right? I think you knew that. All right, why does the risk premium exist, though? Because if I look back over 30 years and I see that the market returns 12%, and that risk premium is, what did we say, 8.5%-ish? Why do I keep getting that? That's actually a puzzle that nobody in the finance research profession can really give you a great answer on. Because if we see that repeated and repeated and repeated, eventually, are we really taking a risk? Well, part of the answer lies in the fact that in any given year, we may lose a whole ton of money, right? We saw that back here in these graphs. We could lose a bunch of money. Look, this year, right after, 1937 or 8? 50% down. We lost half the value. That's pretty risky. You're going to have to pay me something to invest in a cash flow that's like that has even one of those in 20 or 30 years. If I lose half my money right now, I'm not retiring, at least not when I want to. So that's part of the answer. Now, the other question that gets asked even more frequently is the tolerance for risk the same over time? Now, theory argues, or we posit in our theory, that it is constant. But in the real world, is it constant? Are equity markets still going to return to us the same risk premium that we've gotten in the past 30 or 40 or 50 years? And the answer is, we don't know. Remember, we only have this one experiment running. We don't have parallel universes. And as a result, it's tough to know the answer to that question. And it's something that researchers constantly are working on to try to come up with, at the margin, can I say yay or nay on that sort of thing. Another thing is risk tolerance. If the market in general becomes more risk tolerant, then the risk premium can drop. So if we're more willing as a group to accept risk, then I don't have to pay as much for that, right? So a lot of additional things going on there. But here's the second lesson down here at the bottom, the kind of their punchline, is that the greater the potential reward, the greater the risk. In other words, these things are correlated. There are no free lunches. And if you see a free lunch out there, make sure you call me first. No, if you see a free lunch, don't take it. There's an old joke, and I apologize, this is like a dad joke thing, but it's an economist joke. Two economists walking down the street, and they each look down and they see a $20 bill sitting on the sidewalk. They keep walking. In an efficient market, there are no free lunches. So the economists, no, never mind. Yeah. All right. It is a bad joke, I know. But the point is that, hey, if you see something that looks too good to be true, more than likely it is too good to be true. We can go back and look at any number of people who have taken advantage of investors. And it's very easy to want to believe. Bernie Madoff, think about that. I know that predates many of you, but Bernie Madoff, they should rename the Ponzi scheme the Madoff scheme and update it, right? I mean, Ponzi was another Madoff, or Madoff was a Ponzi, really. Ultimately, Madoff convinced a lot of really smart, really wealthy people that he could return to them 10% constantly on a regular basis over decades. And by the way, Bernie Madoff was at one time, I think he was president of the New York Stock Exchange too. So he had kind of good cred. But Bernie Madoff is now behind bars, right? Because during the financial crisis, it was found out that that 10% wasn't really invested 10%. That was other people trying to get into his funds, and he was using their money to pay the people who were already in the funds. So as long as new people kept pouring money in, he could keep this Ponzi scheme going. So things like that look too good to be true, they probably are, even if the person has really eminent credentials and guarantees you, hey, I'll give you 10% all day long, no matter what the market's doing. I've got the secret sauce. Can't tell you what it is. All right, how do we measure variability and volatility? The typical way is with this thing called variance. If you're an econometrician or have any desire to be an econometrician, you also know that variance is the second moment of a distribution. And when we talk about a return, we can't really talk about a squared return, which is what variance does to that. And the reason variance squares things is to get rid of the negative so it doesn't just cancel out and become very close to zero. But we have no clue in the financial market what a return squared is. So the typical thing we talk about is standard deviations, because a standard deviation is the square root of a variance. So standard deviation is square root of, I should say this is variance here. All right. We also assume that returns follow a generally normal distribution. And this is a typical symmetric bell-shaped frequency distribution. And it's important that we know this because it makes theory a heck of a lot easier. Because, and again, not being econometricians or statisticians, you probably didn't know, unless you were really listening closely in Andy Welke's class, that if you know that something follows a standard distribution, you only have to estimate 2 parameters to fully define that distribution. And those 2 parameters are 1, the first moment, which is mean or average, and 2, the second moment, which is variance. With those 2 things, and knowing that it follows a standard, knowing that it follows a normal distribution, I can tell you exactly the shape of that distribution. That's not true of many other types of distributions. There are additional moments. There's a third, a fourth, a fifth moment to those distributions, and we have to then estimate a third, a fourth, and a fifth parameter to fully define that distribution. Why does that matter? That matters because when we're doing things like theory, like the capital asset pricing model, the more parameters we have to estimate, the order of magnitude, we add one new parameter and the order of magnitude and difficulty of figuring out that model goes up by 10. So instead of 2 parameters, I have 3. It's 10 times more difficult to figure out that model. Now, today, with the computing power that we have and the ability to do numerical simulations, then it gets a little easier. And in fact, I would argue that we could easily use 3 or 4 or 5 parameters with the amount of computing power we have. But in terms of being able to mathematically work that out, the fewer parameters we have to estimate, the better off we are. So here's a frequency distribution for returns of common stocks from 1926 to 2018. And they've stacked them up here in these bins, right? So there's one bin that goes from -50 to -40, and another bin from -40 to -30, and 20 and 10, and so on, up to all the way up to 50 to 60. Pardon me. So this shows the number of years. So here there was just 1 year. Here there are 2, 3, and so on. So this sort of kind of, if you squint, sort of kind of looks like a normal distribution. Now, is the year the right unit of time to look at this? That's another question. But for the moment, let's avoid that. Let's get back to just kind of brass tacks. How do we actually compute a variance? And again, I apologize. I'll do this ahead of class next time. I forgot about my little quirk in my iPad not being able to remember some of these symbols. All right, so variance is simply sigma squared, right? Sigma is always used to represent variance, and sigma squared means variance. Sigma is a standard deviation, which is the square root of variance. And again, that should be equals and equals and equals. All right. Now, and again, you probably tore apart the variance formula when you were taking statistics, but let me just refresh your memory on that once. Oops, and this should be here, not out there. That squared should be outside the parentheses. All right, so this R bar is defined as the average. All right, so I'm going to get an average of the returns. And by the way, that's also why I'm subtracting 1 down here. 1 degree of freedom I eat up by using an estimate of the average, because I don't have a population value. I only have a sample. And so as a result, I've got to subtract out that n. That's why I'm not dividing by n. I'm dividing by n minus 1. So that's the average. So basically, we're looking at the return in period I, where I goes from 1 to capital N, and whether that return is above or below the average. And if it's above the average by a lot, then the difference here is a large number. If it's below the average by a lot, then the difference here is also a large number. Did I freeze up here? Can you still hear me?
We can hear you. You did freeze.
All right, so back to where we were. So if we've got a deviation from the mean, we get a very large number. If it's positive, it's a very large positive. If it's negative, a very large negative. The reason we square this thing is because the negatives could easily offset the positives, right? And as a result, then we would get something very close to 0, and that would be meaningless. So we square these. So instead of getting just a positive and a negative, we get two positives. And so that gives us this measure of dispersion. The mean is a measure of centrality. Where's the middle of this distribution? The volatility or the variance is a measure of how spread out is it. Is it really spread out, or is it really tightly clumped around the centrality, around the mean? When we calculate that for large company stocks, we simply take, here's the annual return. Here is the average, and so we're going to put that up in this column, and then we're going to subtract the average from the annual return, so we get this difference between those, and then we square that difference, and then we add those suckers up, and we divide by n minus 1, and we take the square root of that, and so that tells us that the standard deviation in this particular thing is about 12.7%. And remember, the reason we take the square root of variance is because we don't know what a return squared is. Now, we know what a speed squared is. That's an acceleration. So in physics, we can deal with variance. It's not a big deal. In finance, that becomes problematic because there is no such thing as a return squared. But, this gives you some idea. One standard deviation to the right and the left is about 12 and 3/4 to the right, 12 and 3/4 to the left. That's a pretty big span. And that takes up a pretty large chunk of our distribution here. It takes up fully 68%. So there's one standard deviation to the left, one to the right. So, nearly 70%, 7/10 of the outcomes occur within that span. And then we can add to that another almost a little over 25% by doing two standard deviations out. And that captures fully 95%. In other words, there's 2.5% left out here to the left, and there's 2.5% left out here to the right, which isn't much, you would think. And if we do three standard deviations, that captures more than 99% even. The trouble is that if our average for large stocks is 11.9% and our standard deviation is 12.75%, three standard deviations, that's a pretty serious loss. 50%. And we've had those show up. Here's the other really problematic part of all of this. And that is, I'll come back to the central limit theorem. That is this. If you ever need a word in Scrabble and you've got a few letters you don't quite know how to use Leptokurtic. They'll always challenge you on it. There is no such word. Yes, there is. Leptokurtic describes the distribution that we think returns actually follow. So this bold line here is the normal distribution. The lighter line follows what's known as a leptokurtic normal distribution, meaning that it is more peaked in the middle. So in this realm right here, that the midsections are skinnier and that there are what they call fat tails. And it's these fat tails that are the most problematic. If it were just the peakedness and the slimmer midsections, that wouldn't be a big deal. And in particular, it's not just both tails, it's just the left tail. Just the left tail that's problematic. And notice, at least in this idealized drawing, that fat tail adds quite a bit of probability of that occurring. Remember, at each point on the y-axis, this is a probability of that particular outcome. So we have more probabilities here in the middle because of that peaked part of it. We have less here in the sides. So there's more probabilities here by quite a lot, right? We're going from here to here. And there's less probabilities in the midsections. And then back here, we go into more. So we have a higher probability than is expected if we have a normal distribution, and all our models are based on normal distributions. Ooh, that's a problem. Because if I think that a really bad outcome is only half as likely as it actually is, whoa, not good. And therein lies one of the weaknesses of the models that we currently have. Now, people are constantly working on trying, this has been known for decades, right? It's not like this first time anybody's thinking about it. So we're trying to make the models better, but when you think about CAPM and you just strictly talk about CAPM, that has a normal distribution assumption underlying it. So when you're looking at betas and you're chasing alphas, maybe you're not getting an alpha. Maybe you're not getting what you really think you're getting because of that assumption. So you need to use more sophisticated modeling methods in order to really have a better chance of getting what you think you're getting. And it's these fat tails that caused the financial crisis, really, because we underestimated the probabilities of a really bad outcome. And we ended up with a financial crisis. And in fact, it's not one occurrence, right? It's multiples put together that just happened to, it's kind of like the perfect storm was the financial crisis. Because, in a normal world, if somebody goes bankrupt or, one company goes belly up, not a big deal. But because AIG went belly up, it was like one big domino hitting all the other dominoes. And if AIG had been let to go bankrupt, it probably would have brought down the financial sector. And so, this is really, and again, this is a bit of opinion. So I don't want you to think this is pure fact. But I would argue that this had no small effect on causing that financial crisis. The fact that the true distribution of returns is not quite normal. And in fact, it's these fat tails over here, especially this left-hand tail, the bad outcome tail, that is most problematic. Central limit theorem basically just simply says that if we have a whole bunch of observations, most of the time when we group them together, they end up looking like a normal distribution or very close thereof. And that's why we use that. It's also convenient because we only have to estimate those two parameters and so on. But here's the risk that we miss some really bad outcomes. Oh, sorry, we still didn't get to geometric and arithmetic averages yet. Let's talk briefly about those, and then I think we're, dollar weighted, and then we're there. Okay. Okay, so geometric versus arithmetic. Arithmetic is the simple average, and it's good for if I wanted to guess what next year's stock market looked like. Picking the average of the last 25 years would probably be a good estimate. That's the arithmetic average. I'm simply taking each year's return, adding them up, dividing by n. All right. Now, geometric is a little different. A geometric return actually compounds it. So let me give you an example. Because I often think the extreme examples are most illustrative. So let's say that in 1 year, I had 100% a positive return. In year 2, I had a negative 50% return. Okay, so remember, I'm starting with, let's say I start with $1 at the beginning of year 1. So I've got, I start 0. Let me put a timeline in here because timelines are really helpful. So I start with $1. I have 100% return during that first year. So at the end of that first year, I have $2 in my account. And then I go into the next year and I lose 50%, and I'm back down to having $1. So my 2-year return has actually been 0, right? I started with $1, I ended with $1. Nobody could argue with that. It's got to be 0. If I'm doing just an arithmetic average, the way that works is I would say I'm going to put the decimal equivalent. So 100% is just 1. And I'm going to add to that a negative 0.5, which is the negative 50%. So I add those two together, and I end up with a positive 0.5, and I divide that by 2, and I end up with a 0.25, or an arithmetic average of 25% per year. It's weird. I didn't make any money. Started with $1, ended with $1, and the arithmetic average gives me 25%. That's the weakness of the arithmetic average. If there are big swings, arithmetic average is going to deviate from a geometric average. Now, the geometric average would actually give me the right answer. The geometric average would say, I'm going to take this $1 plus my 100% return, times my $1 minus my 50% return, and that is going to equal 2. But I have to subtract off, 2 times, that is going to equal 1. But I have to subtract back off. Notice I've added my 1 here. I have to subtract off that 1, which is my principal that I'm carrying along here, and I end up with 0, or 0%. That's a geometric return. So that gives me the picture, a more accurate picture of over a period of time, if these are the returns I experience, this is what I actually end up with in terms of dollars. So a geometric return is good for longer periods of time, and an arithmetic return is good if you want to estimate the next year or a single year. All right. Now, the example I've given you here is extreme, and more than likely the geometric and the arithmetic would not deviate quite that far from one another, as you see in this example. Now, the less volatile the series, the closer the arithmetic and the geometric returns are going to be. But there's still going to usually be some small difference, and that's due to this compounding effect. But keep that in mind. I'm not. You could walk through this example. They kind of do the same thing that I just did here. They do that with these returns: 16, 32.39, 13.69, 1.38. Add the 1. So this is like bringing along the principal with you. And then you do the compounding. This times that times that times that gives us this. That's right. Yeah, they're compounding this by that, and then that by that, and then down here, and then taking that to the 1/4 power to get the annualized version of it becomes this, and then on a percentage basis, it's 15.34%. If you were to simply do this as an arithmetic average, you would simply add all of these guys up and divide by 4, and you're going to get a slightly different number. But where to use each? Remember, the key is geometric over a long range of time, arithmetic for any given year, and you'll be in reasonable shape. And this just gives you an example of how they deviate from one another. Let's see. Dollar weighted is another very important means of calculating a return. Basically, you can think of, you remember you learned how to calculate an internal rate of return, an IRR, right? Basically, a dollar weighted return is an IRR. And the reason dollar weighted returns are handy is that, most of the time when we're investing, we don't just put in one lump sum and let it ride. We're usually putting in money today and some more next month or next quarter or next year. And as a result, we've got to account for, hey, that's an increase in principal, not a return. So how do we do that? I think this spreadsheet demonstrates it most simply. Basically, if these are our cash flows, so we put in $1,000, we put in $4,000, and we end up with $48.45, we can just simply take the internal rate of return on that series, and we end up with a negative 2.6% return. Obviously, we put in $5,000 in total, and we only ended up with $48.45 coming out the other end. So that's why it ends up being a negative. And I think that's pretty much it for this chapter. Any questions? Yes, Matthew?
In terms of office hours, do you have like set hours, or do you plan to do it like email us?
Both. I do have, what I did was I said, let's do the hour before class. Typically, I'm not going to, I don't think I'm going to start the Zoom meeting. If you wanted to talk at that time, just shoot me a quick email. I'll always get back to you right away. And I'll send you my Zoom room address. And then also any other time. I mean, I'm open pretty much whenever. Weekends are fine as well. Evenings are fine. Daytime is fine. So I'm not teaching anything else. I'm doing research. I edit a journal. I'm doing that. But those are things that I can do at any time. So feel free, if you've got a question, you run into a snag with Bloomberg or whatever it is, feel free to reach out to me. I'll try to get back to you quickly too.
Thank you.
Sure. Any other questions, anyone? All right. Well, then, start reading. And by the way, I did see many of you have already signed up for Connect. I think almost everybody has gotten into Canvas. So make sure you do get into Connect if you haven't signed up for that yet. And get started on chapters 1 and 2. Like I said, chapters 1, 2, and 3 are all going to be due, I believe that's the 10th. I'm going to double check on chapter 3. I think that's right, though. I think I had actually planned to do 1 and 2 today. So I'm already a little behind, but we'll pick up the pace and get 2 and 3 done on Thursday. So those 3 chapter readings are due on the 10th, and then you'll start into chapter 6, and you'll do the homework for chapters 1 and 2, and that's due on the 12th, which is this next Monday. So this is going to be really fast-paced. Try to stick with it. Try not to get behind, because it's going to be tough to get caught up if you do get a little behind. If anything is taking you out of town, or you end up getting sick or something, make sure that you let me know ahead of time. I'd much prefer to know about that ahead of time, and we'll make some other arrangements. But otherwise, try to stay up to speed, because we're doing 2 weeks of a normal semester in 1 week. So it's going to be fairly fast-paced. All right. Have a good rest of your evening, and I will see you Thursday at 6:30. Thank you all. Bye-bye. Thank you. You too. Bye-bye.